Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. He sums up what's been going on for the first month of the year. Crude has done especially well. Hilliard MacBeth, author of the second edition of When the Bubble Burst, Surviving the Canadian Real Estate Crash, talks about inflation, interest rates, China's economic problems, and the new Tesla. Publisher of VRTrader.com, Mark Leibovit, tells us he doesn't worry about whether the markets are going up or down because there's always something tradable as long as there's volatility, and he wouldn't be surprised if the tension between Russia and Ukraine is some kind of market manipulation. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to This Week in Money.
Good to be with you, Jim.
Ross, how would you sum up the first month of trading in the new year?
Well, let's see. Unless you were in one of the very few sectors to have any breadth to it here, this was as bad as they get. The NASDAQ down dramatically on the month. I mean, you take a look then at the S&P and the Dow, so you've got these 10 to 15% moves there from the high. So for any given month, that would be bad. But to start off the year, it doesn't get much worse than this one. So, it's two things. It provides opportunities in terms of finding stocks that have been pulled back to the point of, say, being into capitulation and ready for a dead cat bounce. And on the other side of the coin, you get to see which ones have been the most buoyant. And trade with the strengths rather than fighting things. And here we were a week ago. Market was down about 5% off the highs. And typically, once you break that 5% threshold, 5.5% actually, then within 3 to 4 days, trading days, you'll drop to the 11% level. And that's what we managed to kick in and see on Monday, Tuesday. And most of the indices we look at had a series of signals there. We get our capitulation signal, and this isn't just an arbitrary item. We actually have an algorithm that looks for these things. So we had a capitulation there on Monday and Tuesday. At the same time, our weeklies on the indices were providing springboard signals. So those are mild oversolds within dominant uptrends. And you only see that combination infrequently. The last time was February of 2020, so just about 2 years ago that we saw a signal like this. Typically, and we've got 40 of those signals since 1950. So on average, one every 2 years. Sometimes they come more in clusters, and you'll get a period of years in between. But once you get a signal, there's an exceptionally good chance for a 38 to 70% retracement rally. And this week, here we were. The worst was on Monday, Tuesday. Did a few tests of that through the middle of the week, and on Friday had some strength. The other thing that showed up was that the volatility index, VIX, that got up around 38 on Monday and closed off Tuesday at 32. And that signaled for us one of our upside exhaustion signals. Once again, very rare, and in this case, we hadn't seen one of those in 3 years. And they are also indicative then of market having come to a panic, and even if it isn't the eventual low, it is enough to produce just an exceptionally good rally And that's even, with Powell at the Fed having comments that weren't all that supportive on Wednesday, markets have bounced back exceptionally well. So in terms of the sectors that held up the best, what you've got there, the consumer staples had a mild correction. You look at the regional banks like the KBE index, still walking up very nicely, holding their previous breakouts. But the leader of the whole bunch is in the oil market. We've got a list of a dozen of the oils that we presented back in November that looked good for any pullbacks. That same group of stocks held up extremely well this week, and probably half of them ended up closing at new highs for the year. So there's always a bull market somewhere, and right now the oil complex seems to be where it is.
What's happening with currencies?
Well, Powell was enough to create a real spark for the U.S. dollar index. It had pulled back nicely to the 20-week moving average in the last, I think it was 10 days ago, which was what we were hoping for to find a decent support level. That was around 95, and here we are at 97.25 to close off this week. Trend has been, to the upside since the summer, a couple of mild corrections, and we're at the best levels now since the summer of 2020. Don't see anything there that would appear to stop it. And then for those of us north of the 49th parallel, that strength in the U.S. dollar has meant a break in the Canadian dollar. And considering that oil's doing well and the CRB index is doing well, you would have hoped that the Canadian dollar would have held in better than it did this week. So it's got two strikes or one strike against it and two in favor of it, but it just couldn't manage to have the uptick. So look for a little deeper correction in the next week or so.
What's going on with what they call Dr. Copper?
Well, copper tried to break out through the 460 range in the last couple of weeks, but it just doesn't seem to have any power there. Like the other metals, it sold off in the tail end of the week down here at 433. The trend is still up, but just marginally holding its own. Looking at the moving averages, the key support has been the 50-week moving average, held support twice last year around the $4 mark, then right at the end of the year at about 410. And I would say that at this point, unless it can hold 420, things could become a little difficult here. But when you see this kind of failure for copper to move, that has not been a good omen as far as the stock market is concerned. And, looking at the other commodity indices and the metals, it wouldn't be at all surprising to see a deeper correction. You look at the XME, Metals and Mining ETF, that's closed the week in the bottom 10% of its trading range since last spring. So there's just no power on the upside as far as those metals are concerned right now. And speaking of that, the strength in the U.S. dollar and the weakness in the other commodities means that the precious metals have run out of steam here. So the seasonality is such that gold during the month of January really has to have some good upside momentum to keep going. So it managed to have one decent close a week and a half ago, and then as everything else has rolled over, the gold market has as well. You take a look at the indices, the GDX, the GDXJ, closing right down near the lows of the last 8 to 10 months. So we're probably looking out a time window now or out into a March, April before we can be looking for a decent metals bottom, at least as far as the miners are concerned.
Ross, thank you so much for the update.
Pleasure to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at ChartsByRoss. Coming up, Hilliard MacBeth next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Hilliard MacBeth, author of the second edition of When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. You can follow Hilliard on Twitter at HMACBE, HMacB. Hilliard, welcome back to This Week in Money.
It's great to be on that show.
Hilliard, would now be a good time to read your book, and where can people get it?
I think it's a great time to read the book because we're coming into a very volatile period with both the U.S. and Canadian interest rates going higher, and they can get it at any of the major bookstores or on the online services like Amazon and Kobo, and it's in ebook form as well as printed copy form.
The trucker convoy, the big story in Canada this week. If the truckers were successful in ending all the vaccine mandates and restrictions, what would it mean for everything?
You know, I think when I was talking to somebody from London, England yesterday on the phone, and he said they basically are ending all restrictions there already. And my experience has been in the last few weeks that people are starting to go ahead with that. And some of the jurisdictions that still are locking down are like China, but a lot of the other jurisdictions in Europe and elsewhere are opening up. So I don't expect that the trucker convoy is going to have that big an impact on anything. It is a sign, though, that people are disgruntled. That's for sure.
Inflation continues to be the big financial story. What do you think the real rate of inflation is in Canada, and is that inflation likely to continue?
Well, without going into the details too much, but a little bit, the cost of shelter has been going up with the rate of inflation. The rate of inflation in Canada is officially reported on the Consumer Price Index as about 4.9%, something like that. But of course, we know that housing prices went up more than 20% last year. So the shelter index doesn't count house price increases in it, and that's why the rate of inflation has been able to stay relatively low in Canada, 2 to 3%, recently ticking up to 4.9, in spite of these massive gains in houses. And it's because the approach is they take the monthly cost, basically like a payments cost. What's my monthly payment kind of idea. So with interest rates having come down so much in the last 20 years, the cost of housing, the way the CPI calculates it, hasn't gone up yet. But now that interest rates are rising, and of course rents are starting to rise. I saw a report that rents are up 12% year over year. There's a shortage of rental. There's a lot of new rentals coming on stream, but they're not here yet. So that will start to show up in the shelter costs. So if they really, if they took the cost of housing and calculated it properly, the rate of inflation could be as high as 9 or 10% quite easily.
Of course, the official inflation rate the government gives us doesn't include house prices or energy or the cost of taxes. So it's artificially low.
It is artificially low. It was designed in the 70s to be a cost of living index, and they didn't include things like the house price gains and that, because back then things were much more people were much more likely to just stay in their one place and not make a
well, wasn't
changes.
It back in the 90s both the U.S. and Canadian governments agreed we're not going to include house prices, energy, and taxes in the inflation index because they were too volatile. Let's pretend that people don't have to pay it to live is basically what they said.
Yeah, it was, it's been, they were terrified in the 70s, quite frankly. They were terrified of some of the double-digit inflation increases they were getting, and there was a lot of pressure because a lot of the labor agreements had a cost of living adjustment clause written into them. They didn't want to have any big gains coming through in the inflation index. So they designed it so that it would be less volatile. And of course, there's about 4 different versions of it now, and so it's pretty crazy. And so there's no real good way of doing it, but I think it could be improved quite a bit. Now, of course, if they started including house price gains in the index, and then the bubble bursts, as I'm predicting in my book, then of course we would have deflation, and that's the thing. We don't get deflation very often, but when we get it, that's what would be the result. So I don't know. I mean, it's not just Canada. Countries all over the world have adopted this approach to calculating inflation, and I don't see any signs on the horizon that they're going to change it anytime soon.
So with housing prices being what they are, and we're being told interest rates are going to be going up at some point this year, they're not telling us by how much, but maybe 1 or 2%. Is that enough to upset the housing market, or does it have to rise a lot more than that?
So there's a couple of things going on there. There's both the Bank of Canada and the Federal Reserve had their meetings this week. They both said that interest rate hikes are coming, but they chose to not make any change at this meeting, which I think was a mistake. They're already well behind the curve, as the saying goes, and they had an opportunity to make some adjustments and try and catch up a little bit, but they decided not to. So they're really worried about shocking people. So they decided to shock them with their words. And of course, when they said that the interest rate hikes are coming, and they used a certain language, the stock market sold off quite sharply. And so, but the interest rates that affect mortgage rate, like the 5-year Government of Canada bond rate and that sort of, they can move without the Federal Reserve or the Bank of Canada moving their overnight cost of money interest rate. So, but the market hasn't really started to move yet. The short-term interest rates have gone up quite a bit, but they're still relatively low, around 1.5% to 2%, and that's an amazing situation, given that inflation is about 5% in Canada and about 7% in the U.S. But that's where we are. So, but the mortgage interest rates could go up quite dramatically, especially given that both governments have said that they're going to stop buying bonds. So one of the ways they kept interest rates low was the quantitative easing, which meant that the Bank of Canada and the Federal Reserve were both buying a significant amount of bonds as the government issued them by running deficits. And if they stop buying them, we don't know what will happen, but generally what would happen, you'd expect, would be that interest rates would rise, perhaps quite dramatically, if the buyer, the central bank buyer, stops doing that. And they have both announced that they're stopping. The Canada's already stopped, and the U.S. is saying that they will be stopped by March.
How serious are the various kinds of debt in Canada?
Well, the one that gets all the attention is the government, and the federal government debt, which was quite low going into the COVID pandemic, jumped dramatically because of the $340-something billion deficit that they ran in 2020, and another $150 billion in 2021, which is 10, 20 times greater than a normal deficit. So now the federal government debt is no longer as low as it was. We still have a AAA credit rating in Canada, one of the only countries in the world that has it, of the large developed countries, Germany being the other one. However, even with those big deficits, the federal government debt is not as serious an issue as the private sector debt. So in the private sector debt, and that includes households and corporations, Canada has one of the highest, if not the highest, in the world. And this is the most dangerous kind of debt because, unlike governments, private corporations and households can go bankrupt. And up until now, for the last 30, 40 years, Canadians generally have paid their debts, and especially when it's a mortgage debt, and both the banks and the government are counting on this history to continue, in that people will do everything, move heaven and earth, as the saying goes, to pay their mortgage debt rather than default on their house. And of course, as you know, in Canada, unlike in the U.S., in Canada you can't walk away from your your loss on your house. You have to the bank can chase you down for the deficit if you decide to stop paying your mortgage. But given all that, it still is a very dangerous situation because the debt is the highest it's ever been by far. Higher. Just to give you an idea, the general thresholds considered where private sector debt becomes a problem is around 150% of GDP. And anything above that, in the past, there's been a financial crisis in any country that allowed debt to get above 150% of GDP. Canada's well over 220% private sector debt to GDP. So we passed that trigger threshold, if you like, quite a long time ago, probably 3 or 4 years ago, and it's still rising. So of course we haven't seen a crisis yet, but in the past, when other countries have gotten into that situation, there's always been a financial crisis.
Does it look like the stock market's bottomed earlier this week?
I don't think so. Of course, the stock market is at record high levels. It's sort of it's rivaling 3 or 4 of the other peaks in the last 100 years, according to Jeremy Grantham, who's a renowned longtime investment guru, and he on last week, towards the end of last week, he put out a report which I encourage everybody to read. You can get it at GMO.com. And the title is "Let the Rumpus Begin," and the guy's name is Grantham, and he says that this is going to rival 1929 and the dot-com bubble bursting in 2000. In terms, he calls it a 3 sigma event, which means in statistics terms, it's only likely to happen about half of 1% of the time. So it's a very unusual event where the stock market would get so expensive, and he thinks that we're at that point right now. So it's very unlikely that the sell-off that we've seen so far, which has only been 10 or 15%, depending on which index you look at, is enough. Grantham thinks there has to be at least a 50% reduction in stock prices to cause the bubble to burst and get back to normal levels. So I'm expecting that with the rising interest rates and the extreme valuations on the stock market, that we'll see more volatility in the stock market for quite a few more months.
A listener question from Al. He's asking for your thoughts on the massive LGFV. I don't know what that stands for. What does LGFV Ponzi scheme? LG.
So we're talking about China, and you and I talked about China Evergrande in the past. It's a great big developer in China, the second largest. And the way it works in China is quite interesting. The municipalities, the small local governments, they all have these financing vehicles. So local government financing vehicles, what the LGFV stands for. And what they do is they provide the land because they actually control the land, and they sell access to the land to these big developer companies like China Evergrande. And then there's always a bank involved, usually controlled by the government, that would also lend the money to the developer to build the housing. So it's been a huge cash cow for both the developers and the local governments, because they don't raise property taxes the way we do in Canada and the United States. So there's a tremendous amount of debt in these local government financing vehicles. Because they're guaranteed by the government, people generally see it as a stable situation, but it actually could be very unstable. If there's a slowdown, or if the slowdown that's already underway continues, then this is going to dry up for these local governments. This source of funding is going to create a lot of problems. Now they have talked about. I think they are already introducing property taxes in China, and that's going to be a first. So that they may need to do that if these local government finance vehicles get into trouble. By the way, the largest, so China Evergrande I mentioned was the second largest. The largest is called Country Gardens, and it also recently, since you and I last talked about this, it's also recently gotten into trouble. It's slightly bigger than China Evergrande. It was considered to be in better financial condition, but its shares and its bonds are also starting to trade at a discount. Not as big a discount as Evergrande. The discount on Evergrande is 80 or 90%, but in the case of Country Gardens, it's around 20 or 30% discount. So if you want to pick up some cheap bonds and take a little risk, just kidding, of course. I wouldn't recommend going into that market yet. The unwinding of the property bubble in China will be a very difficult situation, and I expect there'll be lots of bankruptcies before it's done, unless the government steps in and bails out all these companies. But so far they have chosen not to do that.
Of course, China is relatively new to the concept of free enterprise. The government's used to being able to control everything. Do you think the Chinese government is in for a shock when all of a sudden this real estate and empty city syndrome comes back to haunt them?
Well, the thing is that there was a big private sector in China. The entrepreneurs, Chinese entrepreneurs, are always nervous, of course, because the government at any moment could step in and kind of take over. But in the property sector, there's a tremendous number of private companies, very similar to Canada, where they're able to grow, and there's many billionaires that were created in the last it's just really 30 years, since the mid 1990s. But now every single one of these billionaires is in trouble, and these property companies are in trouble too. So will the government step in and take over all this stuff that's basically been in the private sector, if you like? There are property companies that are state-owned enterprises, SOEs as they call them. And of course, most of the big banks are controlled by the government, although they do trade on the stock market. So it's sort of a threshold moment here in China as to see whether the government is going to, basically let the private sector fail and let the entrepreneurial spirit kind of keep going, or whether they're going to step in with government-controlled corporations and take over that segment. But it's not that much difference in North America, because when was the last time in Canada and the U.S. we let the private sector fail? I mean, the thing is, to me, is that capitalism doesn't work if we don't let the private sector fail. So wouldn't it be ironic if China was the place where they actually let these speculators with borrowed money fail, and in Canada, at least, we bailed them all out in 2020, and we're still waiting to see what's going to happen to the people that have all this excessive borrowing and speculation going on.
Could the psychological or financial effects of China's real estate problems have an effect on Vancouver real estate?
Well, to the extent that some of these reports, the first report about foreign money coming into Vancouver real estate was Peter German, who is a retired senior RCMP officer, and he estimated that the annual numbers were as high as $15 or $16 billion. Now, not all of that was coming from China, but most of it was. And there's a new report that was supposed to be out by now, but they've delayed the unveiling of the report for a few more months. But it's going to come out sometime this spring, and we'll see what it comes up with. But certainly psychologically, if people feel less wealthy at home because their property in, say, China, for example, is not doing as well as it was, then they're much less likely to be able to either be willing to borrow money against that property to lever it up and buy something in Vancouver, or maybe the banks, the lending institutions, decide to clamp down. It's a good example of a closer to home example of that would be Whistler real estate. So in Whistler, realtors tell me that it entirely depends on how things are going in Vancouver real estate. If Vancouver real estate is doing well, people feel wealthy, they feel confident, and they jump in and pay $1 million for a condo in Whistler. If things are going poorly in Vancouver, then the sales are much weaker because the money just isn't available. Now, of course, most of it's borrowed money anyway, if you're borrowing against the equity. But if you've got these big gains, it's much easier to borrow against the equity of a property than if you're seeing losses. So I think there's no way to prove it, but my gut feel is that yes, there's definitely will start to see the impact on Vancouver if this unwinding of the property bubble in China continues.
Does it look like interest rates could change the psychological perceptions of real estate?
Well, for sure. I mean, for the person that's going and a lot of the first-time buyers are just getting the down payment from the boomer mom and dad who have these big gains on their homes, so they can afford it's required to be a gift, so they can afford to borrow against the equity in their home, give the $200,000 to the next generation, then the $200,000 plus the young couple goes to the bank and gets a loan for $700,000 or $800,000, and they buy a $900 or $1 million property, and it all works. Now the younger people are not really thinking about things like interest rates and all that stuff. So they're just tired of renting, tired of being rent evicted or whatever has happened to them, and it's just time for them to buy. Maybe they got a baby on the way or something, and they just look at the monthly payments. That's all they care about. But so initially, interest rate increases don't really affect those people that much. But in the end, as things progress, it starts to hit. There's all kinds of marginal players in the real estate business, especially with gains that have been so great as recently. And when that happens, some of them get into trouble, and that's when banks start to get nervous, and the banks, a lot of times these things are triggered by the banks deciding to get less comfortable with lending $700,000 to a young couple that have only been married for a year and only have maybe $150,000 in combined income. I mean, none of that is normal, at least based on past experience. That would have been considered just crazy lending at one point, but now it's pretty much standard.
Does the bond market tend to have a mind of its own, and could it affect the real estate market?
Yeah, the bond market, as we were saying a minute ago, the bond market is not dependent on the Bank of Canada, the Federal Reserve, for not waiting for them to raise interest rates. They've been very slow to raise interest rates, but the bond market, in the U.S., for example, the 10-year government bond, U.S. Treasury bond market is at 1.8% right now. A year ago was under 1%. So it's up, the yield on those things is up 80% already in 1 year. And the Federal Reserve hasn't made any moves at all. They've just talked about making a move. So it definitely has a mind of its own. It's based on what people think. And the surprise on that particular metric is people are willing to accept 1.8% for a U.S. government bond when inflation is 7%. Now, obviously, the reason they're doing that is because they expect inflation to come down. If they started to think that inflation was not going to come down, maybe they started to think the Federal Reserve doesn't have the backbone to actually make the moves that need to control inflation, then they would start demanding 2, 3, 4, 5% on that same bond, and then the bond market would have a big sell-off. So that's one of the things that we're watching very closely, because we talked a minute ago about the stocks being in a sort of once in 100-year bubble. The bond market is also in a similar bubble in that yields are very low. This is probably the lowest yields have been on the bond market in relation to the rate of inflation for the last 50 or 60 years. So it's a very unusual situation in the bond market as well.
Are you seeing any warning signs that a real estate crash could be around the corner?
Well, all I see is signs that people are bidding $100,000 or $200,000 over the asking price. So if you look at the actual real estate market itself, there doesn't seem to be any signs. But if you step back a moment and think about the incomes have not gone up, you think about the private sector debt levels we talked about that are at record high levels, and you think about the interest rates rising, then it would be a surprise if we didn't have a crash in the real estate market. But of course, I've been saying that for a number of years now, so I can't predict anymore when it's going to happen. The only prediction I can make is it will happen at some point.
Where are the safe places to keep wealth in these uncertain times?
Well, one of the things that's interesting about Canada right now is, and I wrote about this in my book actually, is there's a whole big world out there. We tend to think of Canadian real estate and Canadian oil and gas stocks and Canadian banks. Those are the three main things that people have been investing in for decades. And yet, with the Canadian dollar at 78, 79 cents, people can transfer their money out of Canada into U.S. dollars or euros and buy some other interesting diversified investments in other countries. For example, in Canada, we don't really have very many, if any, really good renewable energy investments. but there's a tremendous number of investments outside of Canada. You know, there's Tesla, but there's a whole bunch of other companies that make wind turbines and different utilities that are big in providing renewable energy. And that looks like something that's going to be with us for the next 20, 30 years. But you have to go outside of Canada to get involved in that. So that's one of the things that I would suggest that people really have a close look at, is diversifying outside of Canada. It seems like it's a good time to do that.
Your thoughts on gold versus cryptos versus NFTs?
Well, I don't know very much about cryptos and NFTs, and my instinct has been that it's entirely a function of this bubble that we're in, and the cryptos and NFTs never would have really gotten going, except for the fact that we were in a speculative bubble. But gold has been around for centuries, and there are a number of gold mining companies that are very profitable. And the interesting thing about those gold mining companies is they're very cheap right now. So with gold at around $1,800 an ounce, it's come down a little bit recently because of the worry about rising interest rates. But the companies they've got the good ones have their costs of production, including all the reclamation for environmental purposes, and that they call it the all-in sustaining cost, or AISC, is around $1,000 to $1,100 an ounce. So even at $1,800 an ounce, they're making a tremendously good profit margin. And of course, if inflation gets out of control, then the gold price generally would go up, and these companies will make even better profits than they're making now. Their costs generally won't go up that much with inflation. So that strikes me as a good place to be. I would avoid crypto and NFTs.
NFTs remind me so much of the sports card craze of the 90s, when where people just had all this money. Where else to put them? Let's put them into something collectible. And those same sports cards might be worth something now, but they crashed horribly. Same thing going to happen to NFTs?
Yeah, and I don't even know what you own with an NFT. I mean, it's like you don't get the actual card. You get what do you get, the digital rights to a card or something? I'd rather, if you're going to have a collection, you might as well, when I was a kid, we did coin collections, we did stamp collections and stuff like that. It was kind of fun to have the physical thing in front of you. But this NFT thing, it's just hard to understand what's going on there.
Could the Ukraine-Russia situation affect stock markets or commodities?
So, I know that people are concerned about Ukraine, and in Canada we have the second largest population of people of Ukrainian origin living outside of the Ukraine. So it's very important to Canada for that reason. However, the idea of Russia making some kind of a move on the Ukraine, they did Crimea a few years ago, and really nothing much happened. In eastern Ukraine, there's a very large number of Russian-speaking people already. In fact, little known fact, Kiev was the capital of Russia at one time, if you go back far enough. And so Russia and Ukraine have been joined fairly closely together for quite a long time. And I don't expect that it would impact the stock market very much. It's interesting, the first Iraq war and the second Iraq war, the stock market sold off quite sharply when they first started. And shortly after they started, the stock market recovered very nicely. There wasn't really any long-term impact on the stock market at all from those military excursions. And anything that happened in Ukraine, I think, would be smaller than that, because Germany, for example, is not interested in getting involved with the U.S. and going after Russia. They seem to be much less excited about that possibility. So it's unfortunate for the people in Ukraine. I feel badly for them, but I don't think it'll affect the stock market very much.
The price of lithium continues to move higher and higher. Is this due to the increased production of electric vehicles?
So what happened there this week was that Rio Tinto had proposed a lithium mine in, I forget which country, was it Romania or something? Anyway, and they got it turned down. So the people got worried about the supply of lithium. But in general, lithium is actually quite plentiful. In the Earth's crust, there's a large amount of lithium available. And it can also be mined from the sea. So it's certainly going to be battery components are going to be one of the big investment themes in the next 10, 20 years. But lithium, I don't think is the way to play it. There are a couple of companies that mine lithium, and they're actually doing really well. At least they were up until this recent sell-off in renewable energy stocks. But there are other metal components that go into batteries that may also do well or even better than lithium. There's going to be a lot of nickel needed, for example, no matter what type of battery is used. But one of the difficulties with that investment space is that there's the possibility of a breakthrough in battery technology. And there have been some changes, like recently Tesla and a company called CATL in China have decided to go with a slightly different makeup. It still involves lithium, but it's a slightly different chemistry. And I haven't had the time to do the research on exactly how it works, but it's a cheaper type of battery. It doesn't have the range that the current more expensive batteries have, but it is less prone to fires and cheaper to make. And so there's a huge expansion underway in China on making that new type of battery, lithium phosphate, I believe it's called. So, but China is the world leader in supplying batteries for electric cars. It's about 80-90% of the total volume is produced in China. So that's the place to look and figure out what the next trend is what are the Chinese battery producers doing.
Are you in the market for a new electric vehicle?
I just took delivery of my new Tesla Plaid model, so I wish I wish the weather was better and I could get out and test out that 0 to 100 in 2 seconds thing, but I haven't been able to. There's 3 settings in the car: it's chill, sport, and Plaid. And Plaid is like what we used to call ludicrous, right? And I haven't been able to put it. I've kept it on chill because of all the ice and the snow that's around. But I have made a couple of road trips to the ski hills, and it's a very comfortable car to be in. It's in the winter I don't use the so-called self-driving or autopilot function very much because of the lines on the roads are covered up sometimes with snow and ice. But it is very quiet, very smooth, and very powerful. So I'm pretty excited about when the spring comes and we'll be able to try it out. I might even take it to the track and see what it can do in the quarter mile. Apparently, it's got a really low time for the quarter mile, something like 9.1 seconds. So.
How is it in ice and snow?
It works fine in ice and snow. It's a heavy car, so you have to have good tires. And it's all-wheel drive, all 4 wheels. There's 2 motors on the rear axle and 1 motor on the front axle, and of course a very powerful computer to control the inputs and that sort of stuff. So I haven't had any trouble there. And the only negative for electric cars is the cold temperature, and where the battery power is reduced if the temperature is too cold outside or is very cold outside, so something like -20 and lower, you lose about 30-40% of the range. So if this car, one of the reasons I got it has over 630 kilometers of range, but in the really cold weather that drops down to maybe 400 kilometers. So you just have to stop. You have to make an extra stop if you're going on a long trip to recharge along the way, but the chargers are getting faster. Like there's a new charger in Jasper. There's a bunch of them on the Trans-Canada Highway, of course, and they've gone from they've increased the power on all of them by about 40 to 50%. So the time of charge is much slower or much faster, and the time it takes is shorter. And often the car is ready. But at the time you go in and have a snack and use the washroom, the car is ready to go. Maybe you're not ready yet to go, so it's not too bad at all. It'll be interesting to see because there's a whole bunch of new cars coming out. Like Mercedes has one, Porsche and Audi have several, Volkswagen have several new models out. Even GM and Ford are going to put new models out. Apparently, Ford has got the new Lightning pickup truck coming, and they're all going to need chargers. So it'll be nice to see what happens with where they put the chargers. And I know they're building them out now, but I haven't really seen them. And because the connection is different for that charging network than it is for the Tesla, I haven't really paid much attention to where they're putting them. But eventually, I think they'll have a standard connector so that it doesn't matter which make of electric car you have, you can use. Even Tesla's going to open up their chargers to the other non-Tesla cars, so we'll all be able to use each other's chargers at some point.
Now, in terms of investment, I've heard that there's a shortage of investment in oil and gas exploration. Is that not going to drive oil prices up eventually and make it a super attractive investment?
Well, the thing is that the shale. So what really impacted the North American? Of course, you've got Saudis and Iraq and Iran and Russia, and they all have lots of oil, and Kazakhstan, and they all have oil that they can produce much more cheaply than Alberta can. So the real situation that people talk about around here is what's the situation in North America. And North America, it entirely is dependent on the shale production out of Texas. The Permian Basin in Texas is producing now 5 million barrels a day. So the U.S. was using about 18 million barrels. Their total production was around 12 million barrels. They imported about 6, roughly, and Canada provided roughly 4 million of the 6 million that they imported. So the growth in the Permian Basin is a key factor in whether it'll be good to invest in oil elsewhere in North America outside of the shale fields in Texas, and also especially for Canada, because of course our exports that we ship to the U.S. are more expensive than the locally produced oil in the U.S. The type of oil they get from the shale is a much cleaner, purer type of oil that requires minimal refining. So ours comes from further away, higher transportation costs, and it's a much more complex molecule, so it requires a heavy refining and costly refining input. So with all of that said, right now, Canada's still booming, as mostly Alberta, but some Saskatchewan as well, in terms of the amount of oil that it's selling to the U.S., but we don't know how much longer that'll last. Half of that 18 million barrels I mentioned goes into cars and light vehicles. So if the electric conversion craze continues, some of those millions of barrels a day could disappear as people go to electric instead of gasoline and diesel. So I would be very careful about any long-term. So obviously people love making short-term bets, but that ship seems to have sailed because the oil stocks have really surged lately. So in the last 12 months or so, as oil has gone up to $80 a barrel. Longer term, I think it might be a very difficult way to make money because eventually those barrels that are consumed by cars will come down possibly a long way, and then the demand just won't be there.
Where can people follow you, and where can they buy the latest second edition of your book, When the Bubble Burst, Surviving the Canadian Real Estate Crash?
So they can find that book anywhere at Chapters or Indigo or any of the Amazon, Kindle, all of the different outlets. It's available in all of those places, and independent bookstores as well. And as far as finding me on Twitter, quite active on Twitter. If you want to follow me on Twitter, it's HMACBE, and that's where we do. And also, I do a weekend note that you can subscribe for if you contact us directly at MacBethMcLeodPartners.com, or find me on Twitter, and the link will be there'll be a new. It comes out on Friday, the weekly edition of the Weekend Note, and there'll be a new one tomorrow talking about the Federal Reserve and the end of easy money policy. And then in that, you can find the link to on Twitter, you can find the link to the Weekend Note and sign up there.
Hilliard, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Hilliard MacBeth. He was speaking to us from Edmonton, Alberta. We now go south to Arizona, where I'm sure it's much warmer, for our chat with Mark Leibovit.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.ZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as VRtrader.com. He's speaking to us from Arizona. Mark, welcome back to This Week in Money.
Glad to be back. And as a disclosure, I want to inform everyone that I'm not a investment advisor, nor do I provide investment advice, and what we talk about is for purely educational purposes.
Mark, do you have a special offer for people interested in your newsletters?
Yes, it is we're still using 2021. We haven't changed the code yet, so it's 2021 half off, 2021 HALFOFF, just like it sounds. When you go to VRtrader.com and you order a newsletter, there's a little spot for a promo code. So you would insert the 2021 half off. That applies for any length of time for subscription, by the way, whether you do 1 month or 1 year. So please take advantage of that.
Mark, the stock markets had their poorest kickoff for the first month of the year ever. Are you concerned?
You know, I'm never concerned because the market, we make money because the market moves. Whether it's up or down or sideways, there's always something going on. I mean, last 3 days, for example, in our newsletter and our educational letter, we suggested that buying some inverse ETFs for a trade would work out, and all 3 trades were profitable. We bought some ETF for oil stocks a few days back, sold that for a nice profit. Again, there's always something out there. Volatility is really the key. I mean, I'm not presenting this material saying this is for long-term investors to sit and buy XYZ or suggest buying any particular index or individual stock or sector. Everything is tradable. I mean, we saw a huge run in cannabis stocks and they collapsed, big run in gold, and then it collapsed and started to come back. You've seen it here in the overall stock market. You've seen the individual stocks. It's just a question of volatility. So I'm not concerned. I mean, I guess if you're a long-term investor, but if you're a long-term investor, history teaches you that over the last, couple hundred years, particularly since the beginning of the 20th century, markets go up and there's sharp corrections along the way. But if you have a long enough time frame, if you're young and investing, market comes back. And the classic reversal, of course, was March 2020 on the COVID story, where literally it collapsed and immediately started to bounce back and made one of the most spectacular moves in market history. So if you're worried that we're going into a bear market and you're trading, it should make no difference because you could play inverse ETFs or short stocks. If you're a long-term investor, time is on your side. And, if we have a sharp sell-off, more than likely, in fact, I'm pretty confident that it will come back, and the bear market may not be as long or as nasty as everybody is predicting and hoping for. But even if it is, our approach is I'm not worried about it because I'm not sitting here holding long-term investments. So, VRtrader.com, we focus on more the plays that we think still have upside or downside potential, and we have, a shorter time frame. And so it's actually, I'm not concerned at all. I guess I really answered your question. Now, if you're looking to predict the market, we've talked about the January barometer. First 5 days was negative, which is an early warning for the market for the year. This was created by Yale Hirsch many years ago, the 1970s, that the first 5 days could be an early warning for a downturn in the overall stock market. And then you have the January in and of itself, the entire year. And so far it appears we're going to close lower than we did at the end of 2021, which is the confirmation that we may have further indigestion during the course of the year, and maybe even for the year be net down, perhaps, if you use just the January barometer as an indicator. A lot of this is obviously created in terms of fear of higher interest rates. Of course, we talk about a lot of things on these broadcasts, worrying about China, Taiwan, worrying about Iran, Israel, worrying about Putin and Ukraine. There's always a story out there. North Korea, whether they're going to launch any more missiles and so forth. So markets come down and they come back after these stories have passed. I wonder if Putin was short the market. Bought some put options and put out the story and helped pay for his military overhead over there. There were stories before 9/11 that there were short positions out there for those who knew or anticipated the destruction of the World Trade Center. So, sometimes the word gets out of stuff. I'm pretty sure word got out that Putin was going to be doing certain things, and there's certain players who were, I'm convinced, were connected with that information and went short the market. That's the way the market is. Money rules the world. Word gets out. Traders take positions, and they benefit from these negative stories. That's unfortunately the reality for people who think this is an honest business, that everything is me up and up and nobody does anything on a skullduggery side. Unfortunately, that's nature of markets and investors and greed among human beings. But the long and short here, long-winded, market looks a little treacherous here. I talked about Groundhog Day, if you remember. Groundhog Day, February 2nd. Talk about this every year. 2 weeks either side of Groundhog Day, you tend to get indigestion in the market. Our little friend there, Puxatawny Phil, out in Pennsylvania, of course, there's a lot of other groundhogs people look to besides him. But sure enough, we had a correction. We also have the vernal equinox in mid-March, and sometimes that denotes a change of direction in the market. And of course, we're not in March yet. We have the Ides of March, but there have been some key lows around the mid-March time frame we've seen in recent history. Whether it'll be a low or invert this time, we'll find out. But this is a time with a lot of cyclic activity and a lot of volatility. I'm not convinced we're going into a bear market. It wouldn't make a difference if we did or not, because we'll figure out how to trade it and play with the volatility. But honestly, my initial gut feeling, because the charts are a little negative now, we had a little reversal here on Friday. We actually went long, by the way. Too much negative sentiment out there. Everybody's really scared. If you look at the charts of the market, just put up a big weekly or monthly chart of the market. Yes, we had a little break. I'm looking at the S&P on the weekly chart. It actually held above the 50-week moving average, which is the 50-week or 50-day is a critical level for many traders. But if you look at the chart, it looks like a big bull market. It had a little bit of indigestion for a couple of weeks. It doesn't look like a downtrend to me overall if you take a big picture view of what's happened in the last 12 months or 15 months on the chart. I'm looking at it right now. So it looks like we had a shakeout. Now, of course, it resumes and we start breaking support, then we can start looking at the next level. But with all the negative news and with the fear of rates, and, I've mentioned this in the previous broadcast, I don't really believe rates are going up. I'm probably the only one out there saying that. They're going to, the Fed hasn't even raised rates yet. They're talking about doing it. It wouldn't surprise me at all that even if rates go up, they come back down again because of some outlier event that unfolds. We've seen plenty of those this year, whether it's political or geocosmic. We can talk about the geocosmic forever with all the bad weather and volcanoes and everything else that's going on. But it wouldn't surprise me that the net result is rates may not go up at all or even go back under where they were and even go negative, perhaps even zero, and really fool everybody. Jim, I'm just too much of a contrarian, and I don't believe it. And, I think the Fed is a fraud to begin with. It should be abolished. It destroyed the U.S. dollar ever since it was created back in 1913. It's not going to happen, but it shouldn't even be there. It's done more destruction than benefit to the U.S. economy and the markets, and they're playing the same game now that Alan Greenspan played, taxi cab driver, New York taxi cab driver. You know, you slam on the brakes, you slam on the accelerator, you slam on the brakes again. You know, they don't really know what they're doing, honestly. And, I can, if they were going to do anything about inflation, whether they can control it or not, they'd have done it a lot before this current round of jawboning, which is what apparently is going on. So the long and short for me is too much negative sentiment out there, you know? They could fool everybody. This market by the end of the year or early next year is way into new highs, and everybody's happy again. So, you know, takeout may have been nothing more than a big buying opportunity. Time will tell. We're trading, but I'm too much of a cynic and contrarian not to say it's not possible.
The U.S. economy itself is going gangbusters. It grew nearly 7% the last quarter. Should that be your bet?
Right. I mean, business is good. You know, there's a lot of activity. Real estate is still strong. Rates are really low. Yeah, they upticked a little bit. And it's not the Fed that did it. It was just anticipation of higher rates. So they raised some of the mortgage rates a little bit, maybe half a point or so. Yeah, a lot of stuff still going on. Everybody's busy. They can't hire enough people. Can't find people for jobs. That's what I'm saying, you know. Could be a lot of commotion for nothing. And it could have been, you know, see, the Fed operates, we were backtracking to the previous question. I mean, the Fed operates in a lot of different levels. They could threaten to do something like they've done in the last few weeks and not actually do it, which is really the case. Nothing's really happened. They just talked about doing it. And then, they can actually do something. And then there's so many things that they can do, Jim. I mean, there's probably a list of, a mile long here. I mean, it's not just raising interest rates, tapering, their intervention in the stock market, buying bonds of companies, like Harley Davidson a few years ago, and recently they bought, bonds in some other private companies. They do a lot of funny stuff, and then, of course, they have the power of the plunge protection team, which Ronald Reagan signed into law in 1988, where they could physically and have been going in and buying the S&P and Dow futures, along with individual stocks. So it's essentially manipulating the markets. So, Fed, just a whole other discussion. I mean, the whole thing it's really a comedy when you think about it. But I guess if you can play around with stuff and move markets and people can trade and make money, it makes a lot of people happy and many rich. So it continues to continue. So, the economy is good. Everybody's thinking it's going to go to hell in a handbasket, I suppose, if somebody drops an atomic bomb somewhere or an asteroid hits the Earth or we get a super volcano like Yellowstone to blow up or we get a polar shift on the planet and suddenly you got 1,000-mile winds and the continents start to move. We're all dead. So it really makes no difference at that point, right? So a lot of things can happen here. Solar flares we talked about, a lot of activity in the geocosmic sphere could continue as all this past year, food shortages possibly. We can get one of these, I forget what they call it, whether the volcanic winter, if the volcano goes off, it blocks the atmosphere, you can't grow food, there's starvation, all kinds of issues on the planet. So a lot of things could happen out there, and, you can live day to day worrying about it. I like to write about it because it's sort of fun, and it's not something really discussed that much, but could have a tremendous impact if it does. But meanwhile, we're dealing with the guys that play with the stock market and control the news, and that's really where we're at right now. So the economy seems to be okay. The market had a bit of a correction, and we don't even know what's going on with this virus nonsense. I mean, whether they're going to come out with another Greek alphabet virus in the next few weeks and, scare people again as they just did with the Omicron and the Delta before that, or it's all over. We'll see what happens there. But I think a lot of people just try to stir up a lot of noise and tension. Like I say, with the Putin event, you don't know if this is all politically motivated or financially motivated. He doesn't want to any NATO intervention. There's the problem with the supply of energy, gas, and the fear that Russia is going to cut their countries off if they don't cooperate. And it's all the shenanigans and games going on. But what it does is make money for a lot of people. I mean, if you're trading the natural gas futures or the stocks, there was a move there, for example. Oil stocks ran up. There's a nice trade there. So don't kid yourself. There's big players out there moving the markets, benefit from these news stories, in many instances anticipate or even know it's coming ahead of what we can conventionally hear in the main media. And it's a big game. And what we're doing real here at VR Trader, and I've done for the past 40 years, we're just trying to play the game. I mean, years ago, I kept saying to myself, Jim, what if I can't make money in the stock market? You know, stuff stops moving, or it dies, or something happens and it doesn't become the place to make money. I might have to go work for the post office or do something else to survive. And it's funny, in all these decades, there's always money to be made. There's always something, whether it's gold or cannabis or just the stocks themselves or electric vehicles or, moving oil. I mean, there's always a trading opportunity. And funny, even despite all the bad news, and we've had plenty in the last 40 years, the markets are dramatically into new highs. So what does that tell you? All the news stories, and we can recount all the news stories in the last 50 years, but the net result is the markets are still up. So I think that pretty much tells the story. Stay optimistic. Trading opportunities everywhere. Markets are not going to zero. They're going to correct and come right back to new highs. And it's just a question of trying to time it a little bit if you're trading. Or if you're a long-term investor, just stay with the market. I mean, the Dow was, 35, 36,000. It could easily be 60,000 in the next decade. That's really the perspective you need to take, unless you're day trading it back and forth and you're worrying about a trade overnight and stuff like that. And that's why you come to people like me, that occasionally we get some pretty good trades or ideas out there, and we try to benefit from this volatility.
Mark, it's such a refreshing attitude to have. You don't care which way the market goes. As you said, there's always money to be made. And even the naysayers, you say, well, I can trade on that. Or if they're positive, I can trade on that. Is that more of the attitude people should have instead of people trying to paint the entire stock market or in the investment community with just one brush? I would say it's a palette of many colors, and which color you decide to paint with will decide your future, not the color you get if you mix all the paint together.
Right. If you're bearish on interest rates and you think the Fed is going to raise rates or the market players are doing it, you short the bond. You play the bond market. Basically you buy the bond market. So you short the bonds. You short there's ETFs that are negative ETFs you could buy. They've gone up in price. So as rates go up, the bond prices come down, and vice versa. And you just trade those vehicles. If you think gold's going to go up because Ukraine's going to be invaded, you buy some gold ETFs or some stocks. Or if you just bearish on the market at all, like we did this week 3 times, we just buy some inverse ETFs on the Dow, the S&P, on the NASDAQ, and we traded them. I mean, in terms of our ideas, I'm just happy to make a nice trade over a day or two with these things because the market's moving 300, 400, 500 points a day, so that's a lot of volatility. And just personally, I don't like carrying positions overnight. Just as a trader, I mean, I used to be a floor trader on the Chicago Board Options Exchange many decades ago. Many of you probably know that or not know that. And the people that I worked with on the floor closed all positions out at the end of the day and came in fresh every day. And they took their checks home from the clearing firms, and they're making some nice money. And they say, why stress it out? There's always a trade the next day. You're going to find something. And why carry positions overnight? And they viewed it as a way of making a living. In other words, they want to get their checks every day like a paycheck. They weren't looking to be investors. Well, I made my $5,000 today trading all day. I'll take the money and I'll come back tomorrow and find something else. And that's a pretty good living. That was a lot of money for these guys way back in the 70s and 80s when I was involved with it down there on the exchange floor. So part of it, is this a way to make a living, like a paycheck, or is it a long-term position that you want to take? It's a personal decision, and what I've also learned is 1,000 ways to make money in the market. There's a lot of disciplines out there, a lot of technical indicators. A lot of people use a lot of different fundamental sources to make decisions. It's a huge game, a lot of opportunity. And speaking of opportunity, we didn't even talk about it. I mean, look at the run in cryptocurrencies to the upside, and the big break to the downside has offered, I think, a buying opportunity there after the big shakeout. Tons of money has been made in the crypto sector. There's a lot of young people that I know of personally that made, thousands of % return on some of these NFTs, non-fungible tokens out there, along with the cryptos themselves, both long and short. I mean, you can short the cryptos. There's futures, there's Bitcoin futures, there's Ethereum futures. You can short the ETFs. There's I mean, it's all, again, getting back to the basic comment you made a moment ago, Jim. It's volatility, and if you're trading, who cares?
Mark, could you maybe explain what the whole philosophy of VR Trader is?
Well, I guess the bottom line is trying to make money no matter what the markets are doing when. It originally started, because there's a confluence of tools that you can use. It originally started for me with my volume indicator, which is the VR you're referring to, which stands for volume reversal. I wrote a book in 2011, The Trader's Book of Volume. You can buy it on Amazon. We talk about this particular indicator, but all other volume indicators. There's actually no other book up to that point, and I don't think since, that became sort of an encyclopedia of the volume indicators, because, the old expression goes, volume precedes price. So you want to see the volume come in both the upside or the downside to give you a sense of direction. So I put together this book in 2011, again, The Trader's Book of Volume. I think you can buy it for $30 or $40 on Amazon. And if you want to send me a copy here, and we'll figure out, maybe I'll autograph it for you if you pay the shipping. But in any event, that started the whole thing. But I became very, I educated myself, to complement that with not only just the volume itself. And I got into cyclical forecasts and the seasonalities of the market. Like I refer to turnaround Tuesdays. The market tends to reverse direction on Tuesdays for whatever reason, more than it doesn't. And then into the lunar concept, that you get the correlation between the market and the moon, and then the seasonal patterns, autumn, spring, summer, and fall. What does the market change direction on that? So I got into the seasonal and the cyclical things and complemented that. And I got influence from people like Yale Hirsch, who created the Stock Traders Almanac, we mentioned at the top of the broadcast, who comes out with the January barometer, that the first 5 days could be a leading indicator for the year, and if the month closes up or down, that could also be a confirming indicator. So there's a whole bunch of stuff that's fun stuff that I sort of try to complement the volume stuff to try to get a sense of direction and timing, and not to mention just using some conventional technical indicators that are out there. So it started with volume and expanded, and really what I do is it's a combination of contrary thinking, technical indicators, including my volume, and basically putting it all together and trying to make sense of both the trade and when you're writing copy every day and you're trying to talk to people about the market, throwing in all these other goodies educates them about what else I'm thinking about and what else could affect the markets besides just the volume indicator alone.
Mark, thank you so much for being on This Week in Money. My guest has been Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as VRTrader.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Hilliard MacBeth, and Mark Leibovit, and thank you for listening. If you have any questions for the show or our guests, you can send them to info@howstreet.com. Now stand by for a company showcase update from American Manganese CEO Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Always a pleasure, Jim.
Larry, you were just off the sick list last week. Are you feeling better?
Yeah, I've been coming in, part days for all of this week. I'm starting to feel a little stronger, a little better. I'll tell you, you don't want to get pneumonia at my age because it really knocks you down. But I'm back in the saddle and raring to work.
Larry, your office had a news release this week. What was in it?
That was a news release on a life cycle study, and it was with MinViro out of the UK, well-known and established firm, and we feel that we're in a position now to show that we are protecting the environment, that we have a very low carbon content, that sort of thing. That we feel very, I guess you could say, very enthused about getting a report done now. This is important to the investors, it's important to the government, it's important to everybody. So, that's a big feather in our cap. That's not a short process. It's a fairly lengthy process, but at least we got that in the works, and away we go. And I tell you, I'm really excited about the stuff that came out on Friday last week, and it was to do with the Seeking Alpha article, and that was, I'd have to say that was a article that was done by AltaTrade Partners. It was certainly not, they never consulted us. They went through all our stuff, and I think they did an excellent job of putting a business plan that we had, that we never announced, into perspective. So, they talk about our patents, that they're extremely important, and that they build a moat around our company when it comes to our patented processes. So they did an excellent job, and I was really happy with it. Certainly we were not consulted on it, so it was as big a surprise to me as it was to everybody else that this report came out, and they put us at the top of the heap when it comes to recycling lithium-ion batteries. So that was a great article, and I think that had a lot to do with the understanding our process, understanding what patents are all about, understanding all kinds of different things that most people like to brush off all the time. Oh, I have patents, ain't worth nothing, blah, blah, blah. Well, guess what? They are. And, it's been very important to us. It was very important when we started this whole exercise that we not get involved in shredding and creating black mass until we had a patented process down, until we had those in place, and then we moved on to refining that. Our R&D has been to refine our process, and I got to say that Cametco did an excellent job of doing that. They're working away on spacing out and build for the demonstration plant right now, so that is will be coming. I know a lot of people are asking me, well, what's happening with the DLA? Well, there's nothing. We can only do what they asked us to do, and we have to kind of go along with their timeline. So I can't really give you an answer on when that's going to develop, when that's going to happen, but as far as I'm concerned, we have the process. They need it, and sooner or later there will be a deal. But in the meantime, we'll just keep working away on everything that we're doing, get this demonstration plant up and running. It's not like buying something out of IKEA. It doesn't come with parts and with descriptions on where they go and everything else. It's simply, oh, by the way, IKEA always ends up a screw or two loose. They don't have them. And, but in this particular case, we want to have everything in line. So the guys at Cametco are working at the layout and how it's going to go down in the plant. So, we hope we're on schedule to get this thing going in January. And, but there is things that stop us, like the COVID. It hits Cametco just as it hits everybody else and hits us. I had it. And we got to work within those timelines, and but we feel that we're pretty much along the way, and we'll be reporting on that as it becomes available. So, it's, I know people get impatient. We try to be transparent about everything that we do. We don't like to put timelines out there because timelines are a thing of the past. You just don't know when something's going to happen. And, you don't know what's going to hold it up, whether it's trucking, whether it's COVID, whether it's getting the parts. It just takes a lot longer, and it has to go through a lot of hurdles these days. So, but, other than that, I can't say that I'm not unhappy. I'm looking at the overall market, which is pretty zigzaggy, and, everybody keeps phoning me up and say, what do I think is going to happen? Is there going to be a crash? Well, I think we're in the midst of some sort of a crash. We're up one day, down the next, down 2 days, up the next, up 2 days. None of it makes sense. And right now, of course, it's all hinging on interest rates. If they go up, the market will go down. Probably gold should go up. But we got to work within those parameters, Jim. But I can say one thing. I mean, after being as sick as I was and coming back to work and seeing how things were going on a day-to-day basis, I couldn't be happier. I think we're in the right field. I think that Seeking Alpha pointed out a lot of things to their group, and that was a surprise to us too when that article came out. It was certainly unexpected, and but something was happening. I knew that, but what? I couldn't put my finger on it. So it's been a good week, Jim. It's been a solid week of nothing but advancements for the company, and we've got a lot of deep dives going on our process at this time. We're starting to get people that are starting to block out time to come out and see the thing when it's operating. So it's an interesting area that we're in, and to me it's only a matter of time. I don't know how much time, I don't know how short it is or how long it is, but certainly the interest is out there, and it's with well-known companies. So it's not like we're sitting in the dark waiting for somebody to open the door. It's we got ongoing work, and that work continues. So that's overall, I see the markets are going to be kind of fuzzy for a while. We've been talking about crashes now for years, and we saw a crash last March, and that took the market down considerably. But at that time, I predicted that it was a V-shaped recovery, V-shaped correction, and it was. And this time I think it's going to be more like working your way out of the bottom, depending on what area you're in. So we've got we're still working on our permits for the copper gold project up at Rocher de Boule. I think we're getting close on that, but don't quote me on it. But I'd sure like to have those permits before the end of spring or the beginning of summer. So that's just kind of a thumbnail of everything that we're doing, and we're finding other areas of interest that we don't want to get too spread out. We don't want to get too crazy. We want to focus on our core technologies, which are the recycling, and that's core to everything that we're doing. So, and not only that, but it's the closest thing to cash flow that the company's going to see. So I think everybody should have a fantastic weekend. I know I'm going to. And the sun is shining here. It's cold, but it's shining, and it's looking good, Jim.
Larry, for people who are new to American Manganese, what's the company all about?
American Manganese is a critical metals company that got involved in specialty metals back in 2008. And we developed a process for treating low grades of manganese that the U.S. Bureau of Mines worked on for 60 years. And that process is patented in different parts of the world. And we're doing more work with the DLA on that, or we were doing work with the DLA. Now we're waiting for the next lap. So we took that process and adapted it to our recycling. And we certainly had a great amount of success in that. We've got a lot of patents. We got a lot of patents pending. And, it's just that's what American Manganese is all about. It holds some very strong IP. And that's where we want to focus our attention. Get that plant up and going, the demonstration plant, and show that we can do that on a larger scale, commercialized scale, and move from there, Jim. If you're looking for information on American Manganese, Inc., you should look at the Seeking Alpha article on our site. You can see all of our press releases and everything that we've done, we've talked about, and our transparency on that site, AmericanManganeseInc.com. You can phone the company here at 778-574-4444. You can email me at LREAUGH@AMYMN.com. We are trading on the Toronto Venture Exchange under the symbol AMY. We're traded on the QB board under the symbol AMYZF. And we're traded in Frankfurt under the symbol 2AM.
Larry, thank you so much for the update, and glad you're getting healthier.
Thanks, Jim. It feels a lot better to not be bedridden, but certainly it's a long process to get out of that area, but it's happening.
My guest has been Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place January 28th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.